Today, I'm going to skip a little bit ahead just because we're running out of semesters. So we have one real major topic that I want to make sure I get to, and then I'll come back. I do like this longevity product. We'll come back to it, but it's kind of on the exam, but it's on the exam as that unusual product we talked about. I usually do those as longevity. So I want to talk about ALM, asset liability management. This is something that distinguishes the life insurance industry from every other industry. If you take my risk management class, we talk about this from a bank standpoint. It's a lot easier for banks than it is for life insurance. The big issue for banks is credit risk, that their loans don't pay off. They can mess up on ALM. So you may have heard of Silicon Valley Bank. Silicon Valley Bank went under because of bad ALM. You probably haven't heard of many life insurance companies going under at all, especially not because of ALM. So not only is it the most complicated ALM problem out there, they're also really, really good at it because the actuaries really know what they're doing. It is a job, it is a career an actuary could go into. There's the problem with it is most large life insurance companies, these departments have maybe 2 or 3 people in them. Most actuaries are pricing or reserving. So this is a small department. The property and casualty side doesn't have this at all. It doesn't even exist on P&C side. It's just so critical to the life insurance industry. If they mess this up, the company goes under, but they don't mess it up because you hear so few companies going under on the life side. In fact, what Silicon Valley Bank did, the life actuaries would say, yeah, that was like freshman level finance. How could they mess that up so badly? And I talked to my friends in finance that know Silicon Valley, like, I can't believe they made such a basic mistake. So the life side's really, really good at this, but it is extremely difficult. There are a lot of life actuaries on the ALM side that have their CFAs, so they know the investment side. In fact, most life actuaries on the ALM side know fixed income and bonds better than investment people do. It's a really, really specialized area of finance. But it's not a huge career. There's not a lot of jobs opening up all the time. Heavy on stochastic modeling, on interest rate theory, those type of things. So what is ALM? It's very similar between banks and life insurance companies in some ways and very, very different in others. So asset liability management ALM can be asset liability management. It also can be asset liability matching. It also can be asset liability modeling. When you hear ALM, it can be all 3 of those. So management really is matching. We'll talk about that. It's matching up your assets with your liabilities. Modeling just means you're going to do a lot of stochastic analysis because you have to understand what happens to your business if interest rates rise. What if they fall? What if they fall and then rise? What if they rise and then fall? What if they fall and stay down for 5 years and then sharply rise? So there's something called, and I don't know if I can find it, it may not be out there, but it's called the New York 7. So the state of New York has 7 interest rate scenarios that insurance companies used to have to run. Today, I think with the computers today, New York has probably gone to a stochastic model where you just run thousands of scenarios. But the New York 7, pretty famous. And so it's not so simple to say rates rising or falling. It's the path they take. I don't know if you've ever heard the term path dependent. So it just means it's real important whether rates rise and then fall or fall and then rise. They could fall, then rise, then fall. There's all different scenarios, and the life insurance company has to be able to take care of each one of those. Banks don't quite have that problem. If you think about a bank versus life insurance, the key difference here, banks, they have customers on both sides of the balance sheet. So on the asset side, they have auto loans, they have home equity loans, they have credit card loans. On the liability side, they have deposits, checking accounts, savings accounts. So Nathan, you don't have to go all the way to the back if you don't want to. So your customers on both sides of the balance sheet. Life insurance customers only on the liability side. So they're buying actual investments on the asset side. So that's a big difference between banks and life insurers. it gives life insurers a little bit of an edge because they can manage their asset liability management without messing up their customers because they're managing it on the asset side, which is they're buying assets. If you take my risk class, this does cause an issue because to balance all this out, you could mess up your customers, whether they're on the asset or liability side. So what do you do on my risk management class? We use interest rate swaps to match that. So we can go out to the market and say, hey, we got this gap between our assets and our liabilities. We'll go out to the market and fix it. Life companies can use interest rate swaps, but they tend to use the bond market. So they make everything match by using the bond market. If they need longer term bonds, they go out and buy longer term bonds. Banks, if they need more duration, then they do interest rate swaps that are fixed for floating. If they need less interest rate, they do floating for fixed. But you'll see that in my risk management class. One of the cool, I love doing. This is my whole career, and I hadn't even heard of it when I was in college. And it's really cool. What I love on the life side is that it's much, much more mathematical on the life side than on the banking side. It is one of the reasons Silicon Valley Bank was such a shock is that it really is somewhat easy on the bank side. They can, with one phone call. I did this with the pension plan at UTSA. With one phone call, you can manage billions of dollars of interest rate risk. Why Silicon Valley didn't do that? I think they were just rolling the dice on a steep yield curve. So it's a complex formula. It's very, very mathematical. It is, and in the life insurance industry, it is an actuarial problem. On the banking side, it's finance. Banks don't hire actuaries. Remember that assets and liabilities matching them, when you subtract them, you get net worth. Banks and insurance companies call net worth capital. So you can also call this capital management. You'll hear all of those terms. I was once in a department, it was a brand new department at UTSA called capital management. There's probably 200 people in the department now. There was 3 of us when I was there. But it's all about looking at your assets, looking at your liabilities, because if they don't move together, you lose net worth. And as we've talked about earlier, I'll give you an example of, let's just do MetLife. So if you look at the balance sheet for MetLife, it's almost shocking. You would, if you saw this in any other industry, you'd say, wow, they got a serious problem. So their assets, I mean, look at this. This isn't shocking. Their assets are 677 billion. Their net worth is 28 billion. That's shocking just on its own. I mean, look at the prior year. Well, this is the current year. I mean, 677.5 over 28. That's 24 to 1. Compare that to, say, a Walmart. What is it? 4 to 1 or 3, not even 3 to 1, right? So 24 to 1 versus 3 to 1. Do you see why the actuaries are so important? 24 to 1. You lose $1 in your assets and you wipe out your entire net worth. So it's really, really critical. These are very, very levered firms. Banks are very levered, not as much as life insurance companies are very, very levered. So how do you match up assets and liabilities? So what drives your assets and drives your liabilities? Well, mortality, that's not it. Mortality definitely drives your liabilities. People dying or getting sick, but you're not going to find assets that go up when people start dying. They just don't exist. So that you just have to handle that with the pricing. Inflation is really not an issue for the life insurance side. I know when you did paper 1, they were talking about those inflation-linked annuities, but they don't really sell those. There's not inflation risk. You know, if you buy life insurance, you buy a $100,000 policy, and if you die, it pays you $100,000 no matter what inflation did. So inflation's not an issue. If you take my P&C class in the spring, we do talk about inflation risk there. When Nathan took that, remember we did those bootstrapping the yield curve. So the real key for life insurance and banks is interest rates. Banks and life insurance companies, P&C companies not as much, but banks and life insurance companies are obsessed with interest rates. And this isn't even correct. I said they have $10 in net worth for $100. You just saw MetLife. It's 1 to 24 or 10 to 240. I mean, it's just massive. So it doesn't take much to wipe out the entire net worth of the company. A lot of life insurance companies in 2008 saw their entire net worth locked out on an accounting basis. Fortunately, 2009, everything came back, so it wasn't so bad, but it looked pretty scary. You saw the life insurance company that USA owned, its entire net worth disappeared in 2008 because the bond market got priced down so much. So if assets fall and liabilities rise, I mean, you can wipe out the entire company. So we need to know when liabilities rise, we need assets that are going to rise in value. It's okay for assets to fall as long as liabilities are falling as well. So here's the scenarios. If your liabilities rise, you better have assets that rise, then you're balanced. If your assets fall, that's okay as long as your liabilities fall. What would be ideal? Well, your assets rise, your liabilities fall, but that's impossible to do this without exposing yourself to this. Now, I say impossible. You can do it with collars and swaptions and those kind of things, but it's really difficult to find something that assets rise when liabilities fall, that you don't get the opposite scenarios, assets fall and liabilities rise. It's just not possible to do. Now, you could say, you know, if interest rates are going to rise, we'll buy assets that are really short term. If interest is going to fall, you'll buy long-term assets, but nobody's good at calling interest rates. In fact, there was a study done on economists on their prediction of whether interest rates are going to rise and fall, and they were wrong like 2/3 of the time. You think they'd be wrong 50% of the time, right? They flipped the coin, but they're wrong 2/3 of the time. So we're not good at calling interest rates. So you say, why in the world do you want this? Because you want this bucket because that's the only way you can get this bucket. So this is also known, give me another term out here. This is the term I use in my risk management class. Nathan, did you take my risk class yet? I don't think anyone here took it. It's also called balance sheet immunization. That's a term you normally use with pension plans. Banks and insurance companies usually use these terms up here, but balance sheet immunization is more of a pension plan, but you'll see all these terms. So you can't use the term defease the balance sheet. Defease mean you completely eliminate the risk, and that's just not possible. These businesses are too complicated. So we immunize it. So if you took a flu shot, does that ensure you that you're not going to get sick? Not going to, but it should reduce the probability of it. So you can immunize the balance sheet, reduce the risk of loss, but you can't completely defease it. Who plays in this market? It's the actuaries and the investment team. I've been tempted. A good friend of mine, he retired from Victory Capital. He was the investment team for this. John Spear, smart guy. He could probably tell you the process. I think USA had one of the best processes in the industry. The actuary, both of them were named John. So John Woolsey and John Spear. John Woolsey was the actuary, and he would look at the liabilities and he would tell John Spear exactly what kind of bonds he needed. And it was just this incredible relationship, the two of them working together. So John Woolsey would say, hey, I need some 6-year corporate bonds with this yield. And John Spear would say, hey, I can't find those. I can find some 7 years and some 5 years. And John said, okay, well, you can buy 60% of the 7-year and 50% or 40%, whatever. They worked it out. It was a really amazing process. What did John Woolsey do? He just ran models all day long, and he tested different bonds, and he said, well, these bonds do the best of bringing these two things together. And then he'd go to John Spear. Pretty cool process. On the property casualty side, Donna ran this team, and she never talked to the actuaries. So on the property casualty side, she just ran the portfolio. On the life insurance side, these two teams talked together. I interviewed for a job at another life insurance company while I was at USAA. Made it all the way through to the very last interview, which was with the CEO. And I'll walk in his office. He says, "Oh, I remember you. There's no way we're going to hire you." That's what he told me after this full day of interviews, traveling to Chicago. So I was pretty mad. So I let him know that I'm amazed that his investment team never talks to life actuaries. I'm kind of like, and I can get the job, so I might as well tell them what I think. But his investment team at this company never talked to the actuaries. How can you possibly buy bonds if the people who know the liabilities are not talking to you? So he didn't care for that, but it's like at this point, I didn't care. So what are your risks that you have? So we'll talk in two cases. It is important, the path, but we're going to ignore the path. We're just going to do two scenarios. Rates rise and rates fall. Right? Those are the two scenarios. So when rates rise, we've already talked about that. When rates rise, what happens? Banks become more competitive to life insurance companies. So you have that disintermediation risk we talked about. So people move from life insurance companies to banks. Why is that? Well, because life insurance companies buy 5-year, 10-year bonds. So when rates rise, they bought a bond paying them 5% for 10 years. They're stuck with 5% for 10 years. They can't suddenly start paying more to their customer, whereas banks are very short-term investors. They're constantly making loans on autos and credit cards. Their interest rates rise and fall with general interest rates. So life insurance companies, they're offering you 5.5%, and then this bank's offering you an 8% CD. You have disintermediation risk. We won't get into this, but these are important concepts: duration and convexity. Miles, you remember those from the investment class. Those are the ways you measure it. Duration is your risk related to the direction of rates, whether they're rising or falling. Convexity is your exposure to the volatility of rates. And life insurance liabilities have a lot of convexity. They do very badly when interest rates are very volatile. So this is for you actuaries. If you interview or you finance people, you interview with a life insurance company. Life annuities are like short straddles on interest rates. So what is a straddle? I'll show you a picture of one. This is a straddle. You'll see that V. This is a long straddle. What a long straddle says is if things don't move much, you lose a lot of money, but if things get really volatile, you make a fortune. Miles, you remember how to create a straddle? So you buy. Yeah, so you buy and buy, right? Buy a put, buy a call. So you're out of the money. That's a long straddle. Let's do a short straddle. What is it going to look like? Just turn it upside down. It's upside down. If interest rates don't move much, you make a lot of money. But if they move a lot, you lose money. And so let me show you this chart. So this is what we showed our CEO. This is Bob Davis. He came to USAA. He had done banking, but he'd never done insurance before. And we had this committee that showed him all of our modeling. And we modeled a life insurance company. The red line is the model interest rates move. The red line is what the assets did. The green line is what the liabilities did. If you subtract those, what do? You get net worth. That's what net worth looks like. That kind of looks like a straddle, doesn't it? And as interest rates move, this thing kind of crawls like a worm. As rates rise, it kind of shifts more this way, shifts more this way. Our CEO looked at that because ours are more balanced. It's kind of like a up down, like a frown. He looked at it and said, "Why in the world would I ever sell annuities?" And he said, "Bob Davis, these are huge returns." But yeah, it's horrible. If rates really fall, that's a disaster. If they really rise, that's a disaster. When they rise, it's a disaster because people disintermediate. They go to the companies. We'll have to talk about what happens when they fall. I tried to make this as much like the chart our life actuary showed us, but it does move around. It just circles back and forth. So I had some actuaries call me once that they wanted to do a swaption. What a swaption would have done would have taken, for a little bit of money, they could have taken this tail and had it going sideways. They could have put a cap on the loss. And that's why they wanted to buy swaptions, because there are ways to use the investment market to limit that risk. But yeah, I mean, it's a dangerous business. So You know, it's really bad. The sell straddles, you don't sell them, do you, Miles? That'd be, you can, right, you can lose a lot of money. You can lose more than 100%. That's always dangerous. So it's like a short straddle on interest rates, unless you do a good job of matching the duration and the convexity of your assets and liabilities. I'm not going to go into puts and calls, but that's kind of the idea. It is the idea of an option. Your customers have an option. They can take their money out, and they're going to take the money out when it hurts the company and helps them. So it's an important concept. So life companies, they buy 5 to 10-year bonds. That gives them a portfolio yield. When rates rise, they can't do anything until the bonds mature. So their interest rates are going to just creep up really slowly. They don't pay current rates like banks do. Banks pay current rates, so as rates go up and down, bank interest rates follow that. So insurers see people leaving the company to take their money out and take over the banks. How do you mitigate this? Well, you could buy shorter duration bonds, but that's going to hurt you when interest rates fall. You could put restrictions on withdrawals. You can say, hey, if you take your money out in the first year, we're going to take 12% from you. But the problem is those surrender fees, they go down over time. So after 10 or so years, they essentially go to zero. And that's what you call a legacy annuity. Those are annuities that no longer have any surrenders on them. So people can easily take their money out. When I was at USAA in the 80s, they had like $3 billion of legacy annuities, and the entire surrender was $25. So if you had $100,000, you could take your $100,000 out with no penalty except for $25 and take it over. So if they're paying you 5% and you can buy a bank CD at 8%, you can take your money out, pay USA $25. Very, very dangerous. I'm going to skip market value adjusted annuities. All right, so that sounds bad. When rates rise, that's bad because all the money goes to banks. What about when rates fall? You think, well, that should be good, right? Because they fixed that 5% and bank CD rates are falling. The problem here, and make sure you highlight this in your notes, this is real critical. States require insurance companies to have a guaranteed minimum rate. So when rates fall, they have to pay that. So there comes a point where rates fall so much, insurance companies are making like 3% on their bonds, but they have to pay 3.5% on their annuities. They're just losing a bundle of money. This happened in the 80s as well because state law, interest rates were so high in the 70s, state laws were setting guaranteed minimums at 5%. Can you imagine what happened in the 90s when interest rates fell and fell and fell, and now you have to pay your customer 5%? I remember USA was calling customers and begging them to move to another product, and they were like, I got a 5% guarantee. Why would I move somewhere else? So, so eventually those bonds mature, and that happened in the 80s, right? You bought a bunch of bonds at 10, 11, 12, 13% in the 80s, and then they matured 5 years later at 6%, then matured at 4%. But you have this 5% guarantee there. I say as high as 4.5. I know they had some 5% guarantees. Today, they're offering more products where that guarantee minimum actually can float with general interest rates, so that gives them some protection. But they still have some risk on the rates falling side. So, yeah, they get harmed either way. They better manage these extremely well. They do have credit risk. We'll talk about how they manage the credit risk, and that really has to do with just making sure they have good analysis, and then make sure they don't give all of the return to the customer, that you save a little bit. We'll talk about the haircut here a little bit later. Mortality risks, really not much we can do here. You just make sure you price your product well enough. I do not know of a single situation of a life insurance company going insolvent because more people died than they expected. I know that on the property casualty side, right? A major hurricane, major earthquake, that can bring a lot of property casualty company down. It's just, we ran the Spanish flu through our book. That was a lot of people dying, and yeah, it costs like an extra $100 million. But then the property and casualty side ran their scenarios, and it was like 4 or 5 billion. Like, it's just nothing. It's people dying at a high pace. It's just not that much. So, and we had, COVID was a test for the life insurance industry. They did have some mortality losses, but you hardly notice it. It wasn't that large. There's really no way to hedge this product. I'm not going to talk about this because it's a really stupid idea. I'm going to skip that. We're going to skip that. We're going to go right through the problem. All right. So if you want to go to Canvas, we'll work this problem. We'll work it twice. It's exactly like it's going to look on the exam. So go under the ALM module. Oh, I'm in the wrong class. It's like, where is it? So go to the pretty close to the end, the ALM module. And this very first one we're going to do, and we'll do some of the second one. All right, this last one's a straddle I just showed you, but we're going to start with this first one in Excel, and then we'll do a few in Word so you have some practice, and you also have a YouTube that can help you with it. So I love this problem. I thought I came up with this problem riding my bike years ago. How can we show this in a realistic way? The numbers here are really, really off. You can tell I wrote this in a very, very different year than today. I might do this problem again and give you more realistic numbers, but let's start with what we have here. So let's say a life insurance company has four choices. They can buy Treasury, they can buy a AAA bond, triple B bond, or a high yield bond. The Treasury has the lowest yield, although it's much higher than it is today. Today it's right at, now I don't know what the market did today. The 10-year Treasury has been flirting with 4% again. I think it might have hit 4 today because bonds did rally. There it is. So the 10-year is at 4.002%. So we did get below 4% a few weeks ago, and then the Fed started talking that they weren't going to cut rates. So this is a little bit off. So I'll change this to 4%. AAA, that spread between Treasuries and AAA is absolutely false. That's not true anymore. I'll give you a more realistic spread. Y'all know what a spread? What is the spread? Y'all know how to say that? Miles, you remember from the investment class? How do you say this spread? Well, so you're going to take 625 minus 5. What does that give you? Exactly, 125 basis points spread. Have y'all used that term before? Spread. So the spread is how much you get paid over the risk-free rate. Why is it 125 basis points? That's just the way we don't say it's 1.25%. We say it's 125 basis points. It's just each basis points is 1/10,000th. So 125 basis points is 1.25%. If you're a finance major, well, actuaries, y'all should know this as well. But finance majors should be able to speak in basis points. In the interview, you don't say basis points, you say bips. So you sound cooler because no one says basis points. Everybody says bips, and because it just takes too many seconds. Triple B, what's the spread there? 225 basis points. 225, and then that one's really tough. What is that one? 800 basis points. Wow. That's not true today. Well, today, what are they? It's 40. It's 140, and it's amazingly 250 versus 125, 225, and 600 when I did this, or 800 when I did this exam. Pretty amazing, right? This was high. This is an almost historical. I don't know who's buying high yield bonds, but I wouldn't touch them. You're not getting paid much at all for the risk. All right. So you're going to see on the exam that these first two are not on the exam because no life insurance company would ever buy those two bonds. There's just no way they can. So it's going to be between triple B and high yield, but I'll go ahead and do the math. So these are the yields they can make. The next thing you have to look at is the risk. So you get, what return do you get? The next one is the risk. The risk comes in with how much net worth they need to hold. So here's the net worth requirement from the regulators. They say if you buy a Treasury, you don't have to hold any net worth. You don't need any capital at all. If you buy a triple A bond, a real high quality bond, you only have to hold 0.3%. Triple B, that's a lot riskier, so you have to hold 4%. And high yield, those are bonds that are below investment grade, junk bonds. You got to hold 20%. Now, this is what the regulators say you have to have, and if you don't have it, they're going to come in and shut you down. So this company says they want 50% more than that. All right, I'll show you in an actual exam questions. You can see how this is set up. You don't get to use Excel to do this. So yeah, the regulators say they want 150%. So you just multiply that across. Instead of 0.3%, you need 0.45%. Instead of 4, you actually need 6%. Instead of 20, you actually need 30. All right. Everything in blue is what you're given on the exam. And you calculate everything else, right? Any questions on the capital charge? This is called risk-based capital. Y'all know what banks call it? You ever heard of tier 1 capital? That before? So if you're interviewing with the bank, go look up the Basel Accords and capital requirements. It's much easier to look it up for banks because there's a lot more websites for banks. I wouldn't interview with the bank without knowing about tier 1 cap. In fact, with banks, there's like 4 ratios you should know. You should know the net interest margin. You should know the efficiency ratio, the tier 1 capital, and then the return on tangible capital. There's a few ratios. If you're interviewing with the bank, you just got to know those ratios. But tier 1, in fact, you'd want to know them. Well, there's a few other loan to deposit ratio, and there's a few others you want to know before you enter. You not only know what they mean, but know what your bank has, so you can speak to them. But this, for life insurance companies, property casualty companies, is called risk-based capital, RBC. So the law says this is what you need. You don't want to be right on the edge of being taken over, so you add an extra 50%, and so that's your requirement. And then the other requirement's pretty straightforward. If I give you a $100,000 policy, your reserves, it's their money, so you set aside $100,000. The regulators say you need to set aside 1% of that in net worth. You want an extra 50%, so you're going to set aside 1.5%. This will all make more sense when we see the numbers. So here's the cap requirements. I actually broke it into 3 buckets. The first bucket is called C1 risk. That's your asset risk. That's what these numbers are for. It's really the risk that you lose money because of insolvency. C2 risk is mortality risk. It's risk that people die. Where these are annuities, we're not really worried about mortality risk. C3 risk is what we call interest rate risk, or it's the risk that these people we sold to will take their money out at the worst possible time. It's that disintermediation risk. So if we look at it, this is a $100,000 policy. Someone walked in with $100,000. And we're going to decide which of these bonds we're going to buy. If we buy the Treasury, we don't have any C1 risk, but we have $1,500, 1.5% times 100,000. We have $1,500 of C3 risk. So if you buy the Treasury, you only need $1,500 in net worth. If you buy the AAA bond, you have that 0.45% times 100,000 plus 1,500 gives you 1,950. If you buy the BBB bond, you have 6% times 100,000. You got 6,000 plus 1,500. And I recommend you set up this table. The first thing you do on the exam problem, set up the table. The high yield, you got 30% times 100,000, $30,000 plus 1,500 gives you 31,500. All right. Some more blue numbers. The crediting rate, you want to pay your customers 4.7%. That's based on competitive. I think I told you at UTSA, they based it on, being in the top 25%. How did they do that back then? They had a team of people who picked up the phone and called several companies every month. I don't know what they're doing today. Maybe it's electronic today, but back then they had to call. And I'm sure the people that were calling knew they were calling to check on, do you work for our competitors? So they all did it, but there wasn't. It's not like banks. Banks, you can easily go out to bankrate.com and get rates from all the banks. But life insurance, they don't publish all their rates in any central place. So you have to actually call. But they called around and they say, hey, if we pay 4.7%, we'll be where we want to be competitively. Then you have the expense load. The expense load that's how much money you need to pay the salaries for all your workers and your taxes and electricity. Remember we talked about that earlier in exam one and on paper one. Insurance business is an expensive business. Mutual funds charge like 0.4%, but life insurance companies, they charge a lot. We'll talk about the haircut. So the haircut is for the BBB bond, we want to set aside 0.1% to cover insolvencies over time. High yield bonds, we want to set aside 2% a year. So if the bond makes 13%, we're just going to pretend like it only made 11%. We're going to set aside 2%. Where did I get that? I gave you some history on the second page that shows the historical default rates on these different bonds. Less recoveries for BBB bonds is like 7 basis points. For below investment grade, it was 178. So I just rounded that up to 10 and 2%. So on average, because you do recover some, so 0.12% default, but you recover some, so on average you lose 7 basis points. Was that every single year? Well, look at 2008 and 2009. You lost 3 times that much. And look at high yield. You lost many, many, many more times. It's really, really high. So it can vary. You notice with your BBB, there's a lot of years where you don't lose anything. But in order to average it out, so if you pay the full amount on the BBB to your customer, you'll be great on these years, but then this year you lost money because you had some defaults and recoveries. So it's just average over time. This is really old data. I haven't updated it yet. Bloomberg gives me those numbers, so I could pull it from Bloomberg. But yeah, I'll just use those numbers. And then this firm needs to make a return on capital and return on equity of 15%. So there's all your blue numbers. So the first thing you do is you do this capital schedule because you need this number. Why? Because this is the denominator for our return on capital. So what we need is a numerator, which is our net income. So the next thing you do, let's look at this. You're going to build, most students do really well on this problem. So hopefully all of y'all get 100%. You build an income statement. You start off with your revenue. Then you have your net revenue. You take your revenue minus your default haircut. You have what you're paying to your customers. You can think of that as cost of goods sold. You have your other expenses, and then you have net income. All right, let's start with the treasury. If you put this $100,000 into the treasury, you'll make 5% in interest. So that's 5,000 bucks. Everybody see where I got that? $100,000 times 5% for the treasury. All right, everybody good? What's the haircut on the treasury? So here's your haircuts. How much haircut for the treasury? No haircut, all right? No risk of default. Same thing on the AAA. But look at the BBB, 10 basis points. So for the BBB, you take $100,000 times 0.001, and you get the $100. I'll see where I got that. You can probably figure out where I got the 2,000, right? That's just the 2% times 100,000. What do you notice about the credit and interest? It's the same for all of them, right? Doesn't matter on the asset side, that's what you're going to pay. What do you notice with the expenses? Same for everybody, all right? So those two columns are really, really simple. So let's look at the BBB here. You make $7,250, 7.25%. Your haircut is 10 basis points, so $100. So you're really not, you're gonna make $7,250, but you're gonna assume you only made $7,150 because you're gonna subtract out some. You're gonna pay your customer $4,700. Your expenses are $1,400. So you really just take the revenue and subtract everything else. You can see right away that the treasury will not work. It's just not possible. You can't pay your customers $4,700. Pay your employees $1,400, lose $1,100 and making money on treasury. So if a life insurance company owns a treasury, I can assure you it's 0.0001% of their portfolio, and that's because some states require life insurance companies to buy one treasury, like $100,000 or something. So like the company I work for had $20 billion in assets. They had less than $500,000 in treasuries. So life insurance companies don't even look at treasuries. I remember when I was a bond analyst there for a while, and I'd never bought a bond before in my life, so I said, I better go buy a bond. So I went out to Treasury Direct and I bought a treasury bond. I just wanted to see what it was like. The next day, the head of the research area, he was screaming at me. He said, "We don't buy treasuries here." It's like, I didn't buy one for you. I bought one for me. But he apologized. He apologized the next day. But don't you know we don't buy treasuries here? They just don't give you much yield. I actually like treasuries right now. Why? Because the spreads are so narrow. I think treasuries are actually a pretty good deal right now. But when I bought my treasury, I only put $5,000 in the treasury, and it was like a 5-year treasury, just purely to see how the process worked. AAA bonds, almost the same thing. You'll make 62.50. That's good. You do make a higher interest rate. No haircut. But at the very end, you only up with $150. All right. You might say, well, at least have net income. Remember, we're going to take that $150 and divide it by our capital, and we need to make 15%. Then we look at triple B. You make 72.50, but we'll assume you only make 71.50. Subtract the two things, end up with a return of 10.50. All right, net income 10.50. High yield 13,000. Huge haircut, so you really only assume you make 11,000. Subtract this, end up with the best income. So what do you do with each one of these? You divide each one of them by their capital requirement. And remember, they need to make 15%. So for treasuries, you lose 73%. That's not good. AAA, you make 8%, but you need 15%. So that's not good. Triple B, you make 14%. You actually need 15, so not quite so good. High yield, even though it has this massive capital requirement, 31,500, the 4,900, because its yield is so high, is enough to give you a good return. So what do you recommend? And this is what you have to get on the exam. So get this real clearly in your notes. I don't know if it's in the class notes. Let's see. I might have put it in there. No, I didn't. So this is the only place you're going to get it. So have this in your notes real clearly. So you can abbreviate. The high yield is the only one that meets the 15% ROE target. However, you cannot put 100% high yield. Maybe, and I'm going to give you, this is off the top of my head from when I was in the industry. Maybe you can put 10% high yield. You cannot put, remember these companies have, $10 for every $100 in assets, if not even $10 for every $250 in assets. You can't put all of your assets in high yield because, boy, if you have a recession like 2008, you're just going to wipe the company out. So I recommend 10% high yield and 90% triple B. You can do 90% in triple B. Life insurance companies don't buy single A, double A, or triple A bonds. They buy a lot of triple B bonds. In fact, the life insurance industry is a huge, huge investor in corporate bonds. Really, really important, of course. The property casualty side does corporate bonds. We also do a lot of municipal bonds. Life insurance side buys a lot of corporate bonds. And try to improve the ROE some other way. What other way can you get it? So this is the part of the question I really like. You all have all of that. Some of them are doing a snip online. You probably could do that if you're on Zoom. Other ways to improve the ROE, and my suggestion is just look at the income statement. So what's the first way you can do it? Get higher yielding bonds, right? Go out to your bond person and say, hey, can't you get us some 645 bond? How much would they need? Let's try 735. That would almost do. I don't know how many decimal places I'll need here. Yeah, they don't need much, right? So 725. If they can get an extra up to 735, that's enough to get them over the top. What's the problem with that? So that's the solution. But, well, first of all, the portfolio manager is already doing that. It's not like the portfolio manager is going, oh, you mean you want me to try harder? I was kind of goofing off. You know, I have a golf tournament today. No, they're already doing that. I remember in 2007, John Spear, I remember I talked about him. That was what the committee was saying. John, can't you get some higher yielding bonds? And they kept picking on him and beating him up. You got to do it, got to do it. So he finally gave in and did it. He thought they were risky. And those bonds ended up blowing up in 2008. And they're like, John, why'd you buy those bonds? You idiots. So he did exactly what they told him to do, which comes to the second thing. When you ask a bond investor to get more yield, you are also asking them to do what? Take on more risk. And that's what John did. He went out and bought some Iceland bank bonds, and then Iceland went under. And the government of Iceland said, we can't bail them out. They're too big. So, yeah. So really this first one, I don't think it's that much of an option. The portfolio manager's already out there finding the best yielding bonds they can buy. If they find a bond that's yielding 735, the reason they're not buying it isn't because they don't want a higher yield, it's because they think there's something wrong with that bond. They think it's a triple B bond, but they think it's really a double B bond, and they don't think it's really worth it, and they don't want to take the risk. So they should already be doing that. All right, what's the second thing you could do? You could reduce their haircut, but this is just lying. If you need that to cover risk, that is what you need. Now, granted, our haircut show it should have been 7 basis points and you used 10, so we could justify going to 7 here. Does that help you? Doesn't do much, does it? Helps you a little bit. It takes you up to 14.4, but doesn't fix your problem. So that's just lying. I mean, you can say, hey, let's not use 10. Let's just don't use a haircut at all, but that doesn't help you all. What's the next thing? Your crediting rate. You can reduce your crediting rate. What's the but on that one? Can you guess? You're not as what as you want to be. Not as competitive. So that's not good. You have a target to be competitive in the top 25%. You reduce your rate from 4.7. You could do it pretty easy. You reduce it from 4.7 to 4.6, and that fixes it. Or even 4.65 would almost get you there. Not quite. But you might say, well, what's the big deal between 4.7 and 4.6? It makes a big deal. There were times where 5 basis points was the difference between 50 percentile and 25th percentile. Sorry for the typos. So that's not going to help you much. What's the next thing on the, you remember what was next? Expenses, reduce your expenses. What's the but there? Yeah, do that all the time. You think of life insurance, you go, hey, let's have parties and let's waste money. Oh, wait, we're not as competitive as you need to be. Okay, well, we'll be more careful. No, they should be as efficient as they possibly can be all the time. So always be efficient. Now, do industries become inefficient? Absolutely. So I used to get invited to these banking parties at conferences. And before the banking crisis, oh, they were great parties. After the banking crisis, I mean, it was, they'll do a Happy Meal at McDonald's maybe, but it was much streamed down. So yeah. One of them, we were at the top floor of the Sears building in Chicago, whatever it's called now. They had the entire upper floor, this fancy dinner. I hated it. I hate height. I'm fear of heights. I was miserable the whole time, but very expensive dinner. But so that does happen sometimes. But you know, from a competitive standpoint, if some companies are doing that and others aren't, it gives them a huge advantage. What else can you do? You could reduce your ROE requirement. Reduce 15%. But if your stockholders need a 15% return, if you don't get it, stock price will fall. So the stockholders are going to punish you for that. Why did you pick that 15%? Because that's what your investors need. If you don't make the 15%, I mean, we're making 14. Isn't 14 good enough? Well, no, the stock price is going to fall 3, 4, 5% to adjust for that. And what else could you do? You could reduce your capital excess to 1.5 or the 150%. So you could reduce this, right? Instead of holding 1.5, hold 1.4. Oops. And that fixes it. I mean, your ROE is exactly 15% if you do that. What's wrong with that? If you need 150%, you get the credit rating you desire. Below that would get you downgraded. So you say, hey, let's don't shoot for 150%. Let's just shoot for 140%. Well, maybe you're triple B rated. Now they're going to downgrade you to double B rated or triple B minus, and you lose your rating. So what's the solution? And the solution is there is no solution. Right? There is no perfect solution. What if you can't be competitive? The question, and this is, we talked about some of those that took, well, Peyton, you took my PNC class, and Nathan, remember what Warren Buffett said. If the reason I can't be competitive is because my competitors are doing stupid things, then I'm not going to be competitive. And what would he do? He would reduce this rate. So if I can't give 4.7 because my competitors are doing really stupid stuff, I'll just do 4.6. I'll lose some business, sure, but my competitors are going to lose money, go out of business. That's fine with me. So, but if you can't be competitive because your expenses are too high, then you're just an unproductive, inefficient company. You're probably going to go out of business. So you have to look at each one of these things. If your investors are just not that good, then you hire new portfolio managers, find someone to do a better job. But do y'all have all of these down? There's no essays on this exam except for this one. It's not really an essay, but it's part of the question. And the one on joint life. Remember the one we did on joint life last time? When should you buy joint life? Only if you're older, when the probability of both dying is a bit higher. So here's the one kind of big, it's not really an essay question. You can do it in bullets just like this. But make sure you have that down. You can take a picture of E1 if you don't want to have to write it all down. It'll be in the video for the class as well. If you understand this and you interview with a life insurance company with annuities, you've got a really good foundation for that interview. This really gives you the entire picture. There's really not a whole lot you can do. And part of the issue with these bonds, it's the whole industry is essentially buying the same bonds. It's not like one company has access to some magical bond paying 8.5% out there. It's a very competitive market. All right, let's change this up a little bit. Today, Treasury yields, I'll copy this over here so I don't lose it. Treasury yields are 4%, AAA are 4.4%, triple B are 5.5, and high yield is 6.5. Interest rates are much lower, so our required return on capital is only 9%. How do you think we did? Which bond are you going to buy now? So we obviously have to decrease our 4.7, let's increase it to 3%. Really horrible market, isn't it, right now? It's a terrible time for life insurers with those bond spreads so narrow. They just cannot pay much at all. What if the government requires you to pay at least 3% by law? Which bond would you buy then? So triple B does work here. So you probably could pay a little bit higher, maybe 3.5. No, 3.25, 3.3. Yeah, somewhere around 3.3 will give you that 9%. But you see how low interest rates is it's not so much low interest rates, it's really low spreads. Low spreads is a huge, huge issue for this industry. Because they gotta pay their expense load doesn't change. Their expense load may be even going up with all the inflation we saw. So it's a tough equation. All right, let's look at, I'm not going to save this back. Let's look at a problem like I see it on the exam. All right. I give you two problems. I think we can work one of them kind of quickly here, and then we'll work the other one next Tuesday. So I notice, first of all, I only gave you triple B and high yield. I give you the capital requirement, but then look down here, there's your target RBC ratio, that 1.5. So don't get confused. This 1.5 is the same as that 1.5 I used. So we're going to take that 1.5 times this. It's 100,000 on an exam. I'll make it 100,000. Just makes the math easier. If it's 200,000, you just double everything. Here's all the information you get. My word, look at triple B bonds. That's a really low rate. So your crediting rate's only 2%. So this is back when interest rates were really, really low, but high yield had a decent spread. All right. So if remember the first thing you do, first thing I would do is do the capital charge schedule. You can spell it correctly if you want to. So you have triple B and you have high yield. You have C1 and C3. C1, we need 4% times 1.5. Do be careful on an exam. It's possible I'll do something besides 1.5. Y'all see where I got the 1.5 from? That's what that 150% is. 20% times 1.5 equals 30%. So our C1, we're going to use the 6 and the 3. So our C1 risk is going to be 6% times 100,000 bucks, or $6,000. High yield is going to be 100,000 times 30%, 30,000. Everybody got those numbers? C3 risk. There's your C3 risk right there, 1% times 1.5 equals 0.015. So your C3 risk, likely on the exam, it will be the same, 1,500 bucks. So your capital requirement, 7,500. I think exactly the same as the previous, probably 31,500. Oops. Any questions on those? And then you do the income statement. You need triple B, you need high yield, and just think income statement. You start off with your investment income. You have your haircut. That's what they call it, a haircut. You have your crediting rate. Your expenses. your net income, and your ROE. All right, so just put that across. The triple B makes 385, high yield makes 780, so 385 times 100,000 bucks. It's 3850, high yield. I've already forgot it, 780, 7,800. Your haircut's the same as in the other ones. It's 0.1 and 0.2. You don't have to make any adjustments to those. You just multiply across. So 100 bucks and 2,000 bucks, same as in the other problem. That'll stop me if you have an issue. The crediting rate is only 2%, and the expense load is 1.2%. So 2% is $2,000, and 1.2% is $1,200. And the net income, you just take the first number and subtract all the other numbers. So 3850 minus 100 minus 2,000 minus 1,200. Hopefully y'all get the same answer. 7,800 minus 2,000 minus 2,000 minus 1,200. So 550 and 2,600. You might confirm any of those numbers. And then you divide by 7,500, or you divide by 31,500. See if I can get us some more space here. $7,500, $3,150. $31,500. So plus 550 divided by 7,500 is a 7.3%. And 2,600 is 8.3%. What was our target ROE? Have we used all the numbers? All of them but here, there's our target ROE. So only the high yield meets it. That's likely going to be how the exam comes out, because that's really how it comes out in paper. And so what will be your answer for your recommendation? I just showed it to you over here. Oh, I deleted it. Oh, why did I not save that? Oh, y'all got it right. So, I mean, the obvious answer is they put all your money in high yield, but you just can't do that. You'd be downgraded. You'd be in a lot of trouble. The rating agencies and regulators are not going to let you put 100% of your money in high yield, and 10% is a pretty high allocation. So you're probably going to recommend, and you could try, if you did 90 and 10, so 90% at 733 and 10% at 825, that's still, I can give you the 8%. But that's probably as wild as you can go. And then what do? Either not going to get your ROE, or you're going to try to manipulate the formula in some way to get that ROE, just go across. And this is the real world. I used to sit on the A loan committee, in the life insurance company. And every month it was just this debate. You had the marketing people wanting higher rates, actuaries saying we can't do that, we can't do that. The finance department came in with all these numbers, and it's just a big debate on what are you going to do. You're going to be competitive. We had what we call competitive resources, which said, you know what, let's do this. It only gives us 7.4%, but we have this other product that's making more than its ROE. We'll let it offset. And so they'll steal from one product because they really want to sell this product. So yeah, it's a political game. I like the way USA did it. It was real honesty. A good friend of mine, she was one of my bosses there for a while when I started USA. She had one of those faces you could always read. When she was upset, you could tell. And so I would just watch her face, and I could tell she would have this kind of roll her eyes expression, like, yeah, that's not going to work. And I could tell she's about to say something. And she was so highly respected, she could control the whole meeting just by rolling her eyes. Someone was recommending something crazy. But they knew each other well. They got along really well. They would yell and scream at each other, kind of like brothers and sisters. But at the end, they highly respected each other. And the final answer was take care of USA, but also take care of the customer. And it was a good, honest battle of kind of balancing the customer versus the company and making a good decision. But these are the numbers, and they couldn't. There's no magic to fix all of this. You're kind of stuck with what the competitors are doing. So this essentially is what your answer should look like. And then you have the essay question that I deleted because I shut down that file. But you have those six things. You essentially have 1, 2, 3, 4, 5, right? Increase your investment earnings, eliminate the haircut, pay less, be less competitive, reduce your expenses, have a lower ROE goal, and then the last one is not in there, and that's that reduce to 150%. Those are your 6 options. None of those are good answers because they all have negative ramifications, or they're things people should be doing anyway. So, all right. So on Tuesday after Thanksgiving, we'll work one more. Get a little more practice, and I'll probably go over the essay question again just to make sure everybody's comfortable in that. I don't want y'all losing points. So next week we got 3 more classes, I think, or 2 more. What is next week? Maybe we only have 1 more class. No, we have the 2nd and the 4th, right? So we have 2 more classes. So we will on Tuesday finish up. We'll do another problem here. Finish up some of the notes I really want you to see. Thursday, we'll spend quite a bit of time preparing for the exam, just to make sure, because I threw massive amounts of math at you that you probably kind of understood when we did it the first time, but now you've completely forgotten it. And you're working on, have any of you turned in your papers yet? No? All right, so you're in. All right, so I'll be exhausted next Monday.
I have a question about the paper for the problem about having less doctors, like we're facing a shortage of doctors, like primary care providers. I don't understand how it's a problem relative to like every other country. Like,
well, I haven't seen it comparing to other countries. So the shortage of doctors is a supply thing. So when you have a shortage of supply, the price goes up.
Would we lose points if we like make an argument that it's not a problem, or should we?
Well, at least address it. I mean, you can easily Google it because it is an issue out there. It's not just in the US. If you can spell shortage correctly. Continue projected, so you'll be able to find it because it's been this way for quite some time. That's pretty easy points. So, at least make the basic argument. You get full credit if you want to say in class, we said one of the issues why healthcare is so expensive, we have a shortage of doctors. I disagree with that. You can do that anywhere in the paper. So just make sure you hit the rubric, get the obvious thing down, and then you can, yeah, you can argue. In fact, I love it if you say, I don't think this is an issue. That's perfectly fine. Just get it somewhere in the paper. But you will see a shortage of doctors as a pretty big issue in a lot of places. And the immigration issue is not helping it, because we do get a lot of doctors from India and a few other places that, you know, so and primary care doctors is a huge issue. I don't know if you try to set up an appointment with primary care, they're just, you know, oh yeah, we can see you in March of 2028. It's just, but yeah, try, you know, Googling all these kind of things, you'll be able to find some update. And I think I gave you at least one article that discussed that as well. So, yeah, try to get some in tomorrow, although we'll see. I may have to grade 10 papers a day, which would be really tough. All right, I'll let you out a little bit early.